In this presentation, we will discuss operating leverage. This will be the data set we will be using. We'll have two different companies, two sets of data, company C, company D. The data we will be considering is the sales, the contribution margin, and the fixed costs for each. You'll note as we consider leverage, the operating leverage, we're looking at this big difference between the allocation of the costs between fixed and variable. In other words, Company C's data set, we have a lot allocated to fixed costs as compared to Company D, a lot more fixed costs in C than D, and the contribution margin for C is 60% versus the contribution margin for D, 20%. In other words, C is in the type of company or has a situation in which much more of the costs are allocated to the fixed portions, the things that don't change with the level of production, as compared to the variable. Whereas if we go down to D, we see that the fixed costs are relatively low and therefore the variable costs are relatively high. If we consider this type of situation, you might think of something like a movie theater or something up top where we have to basically pay the rent on the theater whether or not more people are in it or not, whether or not the sales go up or we have more people using the theater or not. The fixed costs might be the same in that type of scenario, as opposed to a situation where if we sell something like we sell food or something like that, we may have a much larger component in variable costs, and the costs then much more of the costs going up with each level of production, with each unit of production. So what would happen if we can consider these things with regard to operating leverage? What we're looking for is some tools, so that when we consider increases and decreases, we can consider the effect on the bottom line. It's one way for us to measure this kind of difference, this measurement difference between the fixed costs and variable costs. It's one way we can do so with different companies, looking at ratios to do this with different companies that may be of different sizes and have different overall revenue and expense numbers. So first, we're going to start off with our standard contribution margin income statement. This will help us to just consider the data. Remember, this is kind of our default statement with a CVP analysis. We've got the contribution margin income statement. It's going to be ending up in net income like a normal income statement, but we're breaking off the costs by behavior between fixed and variable costs. So we're going to start off with the sales, which are given to us at the 1,000,003 and the 2,000,003. So that's going to be the 1,000,003 and the 2,000,003. The next thing we would typically see in our contribution margin income statement is variable costs, but we don't have variable costs, and that's going to be typical in a book type problem. They gave us the contribution margin percentage. So that's what we're going to have to consider, the contribution margin percent. Well, we know that the sales minus the variable costs equals the contribution margin, and the contribution margin over sales equals the contribution margin percent. And therefore, we can figure out what the contribution margin is first with these numbers by saying, well, sales is 3,100,000 times 0.6 or 60%. And therefore, the contribution margin is going to be 1,860,000. So we want to be able to do that with these types of calculations. We want to be able to see the relationship, both to see the relationship and two, so that if we're asked any test questions on it, we can basically understand that. So we got the contribution margin here. Also note that if you look at textbooks, they might show you different formulas as if it's a different formula to figure out these items. What you want to do is basically remember this format. Sales minus variable cost is the contribution margin. Contribution margin divided by sales is the contribution margin percentage. In other words, you don't want to rememorize another formula to figure out what the contribution margin is. You just want to basically plug in the missing information. As long as you can write the algebraic equation with one variable missing, you don't want to rememorize multiple equations that have different formats of the same equation. In other words, and I know this is ugly, but bear with me here. If we say the contribution margin percent, that's what we typically think of. We're going to calculate the contribution margin percent is going to be the contribution margin here divided by sales there. And that's going to give us the contribution margin percent. But in our question, of course, we already had the contribution margin percent, and we didn't have the contribution margin amount. Well, a book problem might tell you, here's the formula to figure out the contribution margin in that case. contribution margin equals sales times the contribution margin percent, as if you have to memorize a whole new formula. You don't really want to memorize a whole new formula. You just want to recognize that the missing variable here is going to be the contribution margin. And then we just use the same formula, and then you don't have to memorize another formula. You work the algebra to solve for this item as the missing factor. So just keep that in mind. If you start to look at managerial accounting and start to think that there's all these different formulas, sometimes it might just be variance on the one formula, and you just want to remember that you could basically remember the main variant of the formula, plug in the missing variable. Next, we're going to calculate the variable costs. So if we have the contribution margin, and this is the same case, contribution margin is usually calculated as sales minus the variable costs, giving the contribution margin. Well, if that's the case, then we know that the variable costs is sales minus the contribution margin. So if we don't know the variable costs, then we're just going to take the sales 3100 minus the contribution margin 186060000, and that gives us our variable costs. And then we could double check this. 310000 minus 1240000 equals the contribution margin, and that divided by the sales 310000 equals the 0.6 or 60% contribution margin percent that we started with. So we do that for C and D. I'm not going to do all the calculations for D as well, but notice similar types of calculation up top. Then we're going to have the fixed costs. Those are given, so those are pretty easy. They don't change. They are what they are. They're given in the problem, and they're very different. We got the 1,390,000 versus the 150. If we subtract those two out, then we get the net income. So this is going to be our starting point. This is basically our net income calculation with a contribution margin type of income statement. Now we're going to take the top of that income statement, sales, variable cost, contribution margin, and calculate the new item we're considering here, the degree of operating leverage. This is the area we've been looking for. So we have the contribution margin. So here's the contribution margin we're pulling down. And then we're going to say the net income. And the net income is 470. We don't have that in our data set, but that's the 470 and the 490. So there we have that. And then if we divide those two out, we're going to get our degree of operating leverage. So we're taking the contribution margin, 1860000 divided by 470. And that's going to give us, it's not perfect here, 3.96 about. There is rounding. We're going to round to 2 decimals and just be aware of that. If our information doesn't come out perfectly, it's going to be a rounding information. If we had this in Excel, it would take into account the full number rather than us rounding to 2 decimals. So just keep the rounding in mind. It's something we always have to deal with. So now we can consider our situation. How would we use this to illustrate what kind of questions we would want to answer? Let's first think about a full contribution margin income statement as if there's a 20% increase in sales. Remember, when we think about the CVP, we're often projecting into the future. So we're saying, well, what would happen if there's a 20% increase in sales between these two type of industries, C and D, these two companies that are very different with the distribution of costs between variable and fixed type costs? Well, we can start off with the sales is going to be increased by 20%, which of course is going to be, we can calculate this 2 ways, 31000, there we go, times the 0.2, 20%, there's the increase, plus the original number, 3100000, there's our sales. Or of course, one way with one calculation, 3100000 times 1.2, 120%, 20% plus 100%, and there is our 3,720,000. So that's increased. We also know that the variable costs are going to increase. Why? Because they increase in the same percentage. That's why we broke them out between fixed and variable. So we're going to say that that means that the 1240 times 1.2 is going to be up to 1,488,000. So we know that's the case. And then we know the contribution margin is going to be subtracting these two out. So we've got the 2,232,000, D's following suit. I'm not going to go through the calculations for both, but just note D's following suit here with the related numbers. Fixed costs remain the same. These were the same fixed costs we saw at the beginning with the given data, and that gives us the net income. So we've now calculated our change with this what if kind of analysis. What if there's a 20% increase? The next thing we're going to want to know is, well, what's going to be kind of the percentage increase, or what's the change from net income, what we had before 20% after. We had a 20% increase in sales. What's the increase in net income from a dollar amount and the percentage increase? Well, here's how we got that. We're going to say, here's the contribution margin income statement before. Here it is after. We could say that the net income change for C and D, so if we calculate C again, it's going to be the 470,000 minus the after number, which is 842,000, and there gives us our $372,000 change. So there was an increase of 372 versus 128 when there was a 20% increase in sales. That's useful. You can see that big difference here. And that's useful here because the numbers are relatively similar as well. You can see that they make relatively similar amounts of revenue. But what if we're talking about industries and companies that don't make anywhere near the same type of overall revenue, but we want to see the relationship between the numbers? Then we want ratios. We want the percentage change. So now we're going to consider the percentage change and say the percentage change is usually the change, 372,000, divided by the original number where we started at. In this case, the 470. And that's going to give us the 0.79. So now we've got the 0.79. If I do the same calculation over here, 0.26 for D. So we can see there both ways we can see, and it's very distinct in either method. We can see the dollar amount being very different with a 20% increase, much bigger dollar amount change in C than D. And even if we didn't have the same dollar amounts, but the same relationship between the data, between variable costs, fixed costs, contribution margin, net income, we can still do a comparison and use this percentage change and say, wow, a 20% increase in sales results in a 79% increase for company C and only a 26% increase in D. Why? Because of that big difference in the distribution between variable costs, fixed costs. An increase in sales in a company that has mostly variable costs will increase the variable costs in a similar relationship. An increase in sales for a company that has a lot of fixed costs means those fixed costs will remain fixed while the sales go up. Therefore, if we're in a type of industry that has a lot of fixed costs and we can increase sales, we might see a very substantial increase in the bottom line as well, as opposed to a company that has a lot of variable costs. For example, if we had the movie theater, or if we had a restaurant, or if we had hotels or something like that, if we had hotels, let's say, and we increased the amount of occupancy in the hotels, well, if we had a lot of fixed costs, a lot of the costs, basically the rent of the hotel, and it is what it is, whether people are in it or not. And therefore, if we only had a couple people that are staying in the hotel and getting revenue versus an increase in that, if a lot of our costs are just in the fixed costs of the hotel, just maintaining the hotel, whether there be people in the room or not, a lot of fixed costs, then the increase in sales will have a substantial increase on the bottom line, as opposed to a type of business where the variable costs are very similar to the fixed costs. If we sell food, the actual food items that we sell, as opposed to the space, the actual food items that we sell are going to increase in the same proportion. The variable costs will increase. Much of the cost will be variable, will be increasing in a similar proportion as the sales. And therefore, an increase in the sales won't have as much an increase on the bottom line because the variable costs will be increasing in a similar proportion. How can we get to this calculation a little bit more quickly? We can consider this calculation a bit more quickly with the degree of operating leverage calculation that we saw in the prior slide. So now we have our degree of operating leverage. If we take our degree of operating leverage and multiply it times the percent increase in sales, in other words, we calculated the degree of operating leverage taking the contribution margin divided by the net income, and then we can do projections and say, well, what would happen if there's a 20% increase in sales, and just multiply this item out. So we can say, all right, well, if there's a 3.96 degree of operating leverage times 0.2, then we've got about 79.2%. And again, there's rounding in these numbers, so be aware of that. But these are generally projections in and of themselves. Therefore, the roundings are estimates, and we just want to round to the point that is relevant for our information. So here we're going to round to 79 and 76%. So note we get to that percentage increase a lot more quickly here, and that's going to be one of the advantages we have to the degree of operating leverage type of calculation. We could say, okay, well, let's compare these two types of industries, and let's consider types of increases and types of, what if there's a percentage increase in sales? What would be the effect? What would be the effect on the bottom line, on the net income? Top line sales increases. What's the bottom line effect on the net income? Why would it change from company to company? Because of the behavior of costs, because of the difference between variable costs and fixed costs, the allocation between variable and fixed costs between different types of companies, different types of industries.